Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. I say interesting too much, so I'm not going to say it for the rest of the show. I promise. It's 11 a.m. on the East Coast, 8 a.m. on the West Coast, and if you're in between, does it really matter? The time is what it is. And yes, I've just insulted 85% of the country, but you know what? I'm goofing around, as you know. This is Market Call. Guy Adami, Dan Nathan. If it's Wednesday, it's Butters, bitch. Yes, it is, Dan. You got to be faster than that, man. You got to come right in, right in.
So I went to the Perplexity guy and I put interesting synonym in there. Don't
you went to, wait a second, what?
So, you know, it's the search engine of choice right now.
Oh, I see.
So synonym, fascinating. And we use fascinating actually a little bit.
I do.
Intriguing, absorbing. I've never used the word
absorbing.
Engaging, gripping, riveting, compelling. I don't think any of those really kind of
compelling is good. Riveting. You know, riveting, you're typically riveted by a great baseball game. Like
right. So
bottom of the ninth, bases loaded. I'm riveted.
You're on like the edge of your seat. That would be riveting.
I was riveted by the Ranger game last night, but they'd lost. They really suck. But that's not what we're here to do.
No, we got a lot to do because you said we're going to do Butters. And, you know, this is a really, I think, important time as we go into quarter end. And I'll get your take on what you think, how this kind of, you know, works itself out. But then as we get into like the first week of April, remember we used to get a lot of pre-announcements by companies, you know, like I think there was like a threshold. If you were
that was a thing.
Or miss your earnings or sales, you know, like by a certain amount, you would pre-announce. I feel like we rarely get pre-announcements anymore. But it'll be interesting given the tariff and the trade war situation. You know, we've given tons of examples where if you're a retailer, might you be double ordering some stuff China right now in front of that or wherever, you know what I mean? Canada or whatever. If you're if you're a buyer of semiconductors, might you be doing the same thing if you're over there in China? So like there might be some major disconnects as it relates to companies and their supply.
You know, I'm glad you brought that up because there's clearly going to be a pull forward and it's going to manifest itself in some of these economic numbers, which would suggest that things are improving. But if in fact it's a pull forward and then you don't see the subsequent demand on the back end, that's when you're going to see margin declines. By the way, to a certain extent, we saw it with retailers during in and out of COVID and those types of things where people just set themselves up entirely wrong. So we could be setting up for another type of those situations. If you're looking at the copper market, I think there's a lot of what's going on in terms of the price of copper is predicated, is built upon exactly that. I think there's a huge pull forward ahead of whatever's going to take place. And I don't know what's going to take place because quite frankly, I'm not sure the administration knows and that's not a knock. I just think that that's what's going on right now. So you're going to see some funky numbers coming out that the market's going to need to interpret. One of the reasons I think that yields are higher, and again, it's just me, it's on the back of these things that may or may not come to fruition. So let's see how it plays out, Dan.
Yeah, you know, there was an article, I think it was in Barron's, talking about in front of these, you know, export curbs of high-end GPUs. There was a lot of double ordering by the Chinese and like, and we've also talked about this article that was in the FT talking about the Chinese, how they put some, you know, some energy efficiency rules in place, and they're kind of encouraging Chinese buyers of high-end GPUs from Nvidia, you know, to kind of say basically these don't fall within the new rules that we put in place. And you know, today, you know, I'm enthralled, Guy, by the price action.
You're riveted by.
I'm riveted by the price action in Nvidia. You know, it's kind of right at that 115.
Throw the chart up, Amanda. Come on, let's do this thing.
So riveted. You know, listen, for some of you, hey, put in the chat if you guys do we spend too much time.
By the way, if you have questions, throw them in the blow.
Oh yeah, we're gonna hit a bunch of questions, right?
Blow up Amanda's inbox.
Yeah, and we want to do. Listen, you know, this is a day, Guy, where risk meets opportunity. And so we're going to focus on the macro a little bit in a second here. But to us here, like move that chart out a little bit so we can see that right side of it, please. When you look at this thing, I mean, you know, we've been in this range, right? And that bounce, while it looked like 16, 17% off those intraday lows, what was the level, Guy, on March 11th, the intraday low?
I believe it traded down to 104.85. I might be off by a cent or two.
And it closed that day, you know, up $4 from the lows here, but we're kind of banging around. We never got to retest that 200-day moving average, with which the S&P futures did. But this is one where I think the news flow has not been good, and it doesn't seem to get better. And any enthusiasm coming out of GTC, their user conference last week, has really met with just a, kind of a thump a little bit here. So again, this is one I'm riveted by.
You have to be. There's clearly some headwinds that the market, I think, is starting to take into consideration. So just keep your eye on this chart. Now, if Amanda can quickly go to a Taiwan semi chart, it's going to look pretty similar. I mean, Taiwan semi, I think, Dan, traded up to 227 or so, that all-time high. And if you look at it today, I think it's trading about 176 or thereabouts. It's a very similar chart because, quite frankly, they're, in a lot of ways, they're very similar companies. So you had a stock that made its all-time high, breached, whatever word you want to use, the 200-day moving average, bounced but didn't trade back up to it, a moving average that is now flattening out. I mean, I think that's pretty clear. And if you can see continued selling in this name, at some point that moving average goes from flattening out to sloping lower, which is something we haven't seen in quite some time in either one of those names. And again, I don't think you can overemphasize the importance of these two companies, not only to economies, but to the markets, I think, and that's what we're focused on.
Yeah, it is also like the fact that this stock is well below that deep seek level, right? You see that gap. This was in late January. It's basically nearly 2 months to the day here. And again, never tested its 200-day moving average. Right now, it's down about 23% or so. Let's pull up the SOX, the SOXX, the ETF that tracks
the preferred ETF.
That's our preferred ETF right there, right?
Oh,
the iShares Semiconductor ETF there. This thing is just god awful. I mean, like, it really is. And we've made this point, or you made this point again and again. I mean, it looks a lot like the Microsoft chart over the last year or so, but this is telling you that Nvidia and the Taiwan Semi, these are really like the battleground stocks, because so much of the other names in this index have just acted so poorly for a long time.
Can we widen this out, Amanda? I mean, when I say widen, go about 5 years or so, because we're looking at the SOX now. But if you take the highs that we made in 2022, excuse me, and you're right there, stop. So you see that line right there. So you had what was pretty much a double top if you go to the next sort of point. And then we sold off into December of that year. We subsequently traded higher, broke the double tops, and we were off to the races. But you look at where we are now and, go back to that sort of horizontal line. You are at some pretty interesting levels here, Dan, Nathan, in terms of what we could possibly be doing. Theoretically, this should be a huge support. Now, that's the SOX.
Oh, yeah.
I want to go to the SMH real quick. I know we've gone away from it, but this is going to look a little bit different. So these double tops took place a lot lower. So you see those same highs, Amanda. Draw that horizontal line from that one. So my point is, there's a long way to go on this one. And this one is predominantly Nvidia, as we've said. So there's some damage being done in the semiconductors, whether you look at the SMH or the SOXX.
That is a fascinating comparison, Guy. And because
you see what I did? Was that pretty good, right? I did that
on the fly.
On the fly.
31% of the SMH is Taiwan Semi and Nvidia. Nvidia is 20%, and Broadcom is 8%. Qualcomm, oddly, is 5%. That thing's been nowhere. But that, Guy, if you were to get back to that breakout level, that would be a 45% decline from that prior peak.
And
so
I think, can I tell you something? I think we're going to. Now, if people have been watching or listening to the show for a while, or Fast Money, I've been saying this for a while, and it's been dead ass wrong. But I thought there's a really good chance that we're going to find ourselves in an environment where those prior double tops, which, by the way, held up for a few months as we got into late 2024, or excuse me, late 2023, I think they're going to be sort of revisited. And in terms of the SOX, the SMH, I think that comes in around like 165 or something, if you want to sort of look at those levels. Anyway, that's just me pontificating.
Yeah. Let's just talk about the SOX SOXX for a second, if Amanda wants to go back to that. Why I like this construction of this ETF much better, Guy, is that 8% is Nvidia, nearly 8% is Broadcom, nearly 8% is Texan, AMD is 7.5%, Qualcomm is 6.5%, Intel's 4%, KLA is, it's just like, to me, this is just a better constructed ETF.
And we are at support. So this is, and we're getting bogged. I apologize, but We are at clearly prior resistance becomes support. So just for the last time, Amanda, draw that horizontal line. If we were to sort of violate this line, then I think you can draw a straight line to, I think, what's going to be some damage in the less robust ETF in the form of the SMH. So keep your eye on this for sure. All right, let's get away from this. Let's go to Wall Street analyst and the strategist out there, the Barclays. You know, the British tend to put an S at the end of everything. For example, they'll say Goldman's or Morgan's or Barclays, those types of things. It drives me, Merrill's drives me freaking crazy.
Yeah, but Barclays
I don't
is
live
just
there.
Barclays.
Barclays has an S.
Barclays is Barclays. By the way, while we're looking at this, is this the laziest graphic you've ever seen for
Wall Street with
Wall
some
Street.
Johnson? I mean, that dude is just a Wall Street asshole. Bill,
By the way,
does Bill Hockman have a microphone? I mean, that is like
funny. Bill, what do you get in here? Do you see that? Do you have anything for that? I mean, we're putting him on the spot, guy, because normally he works on a lot of his material and you know, tested, and this is not a great test center for it.
No, I apologize.
Lazy stuff there on the graphic standpoint. Getty Images, you got to do better than that. We're talking about Barclays. They're lowering their price target for the S&P 500. It's down to 5,900. Again, this is, I don't know how useful it is. I hope that they're cutting earnings estimates for the S&P 500. If they're just playing a game with the number, you know what I mean? That's kind of a waste of time. But again, we spent this is actually interesting. Oh, there it is. Interesting.
I didn't do it.
I did it. We spent a lot of time in the year end and the start of the year focused on where the Wall Street strategists, you know, where their 12-month price targets are clustered in. I think the average like 6,600 to the upside. Now we're spending a lot of time talking about who's the lowest. And that's an interesting, that's a really
riveting.
That's a riveting. I don't even know where I am. I'm just gonna say it. That's really interesting that we've seen this shift. All right, there's the E-mini, the 500. There they are. S&P 500 E-mini futures guy. We didn't get to that 200 yet.
Yeah,
didn't get.
Listen, I think we've done a decent job here. We talked about the potential to violate the 200-day. It happened. You saw that pretty significant sell-off. Probably happened on some significant volume. Obviously got ourselves very quickly into oversold conditions. We talked about that. Doug Cass a couple Thursdays ago talked about how the market was setting up for a short-term bounce, and that proved to be correct. I mean, almost to the day. And here we are. We thought we could get back up to that 200-day moving average. And as I said yesterday, if you take the 50% retracement of the prior all-time high that we saw a month and a half or 2 months ago in this recent low, 58.25-ish was sort of a retracement of that. I don't know where we got today, but as sometimes like to say, close enough for government work, and we'll see how the rest of the day plays out. But I think you're sort of getting, in my opinion, you're sort of getting long in the tooth in terms of this bounce, and I think the market is going to start to pick up on that as well.
Yeah, I mean, maybe there's an opportunity in the futures to get back up to 58.84. That's kind of that 200-day moving average. But I want to go to the cash for a second because this might help inform a little bit about the next move in the futures. And what I find, you know, like, look at these levels.
You were about to say it. You caught yourself. You were about to say it. Admit it. Just admit it.
No, move that over. The cash chart that I'm looking at shows that we were actually contending through. Is that the 200-day moving average?
Should be.
Yeah,
that's the 150. You changed it to 200.
See, Amanda.
No, listen. There you go.
Okay, let's get rid of that 150 altogether.
Draw a line.
You see November 5th, and you see that gap. Go to the November 5th low right there. Okay, the close. Look at that guy. I mean, if there was ever a level that you want to lead into, and so let's go back to the futures for a second. So if I'm trading the futures and I'm looking for, move it over to the left, please. Right there.
This is, by the way, Amanda, this is Salty Dan you're dealing with, right? I can hear it.
Oh, by the way, this is the 200. That's why I thought that was weird.
I just said it's a 200.
Well, I know, but she was using the 150 the last time we were looking at the futures.
Don't yell at Amanda.
I didn't even need to go to the cash. Okay. So look at that intraday high. Was that 58.09 from today, which is basically the high over the last, kind of 3 trading days.
Mm-hmm.
I'm selling the futures right here, right at this price, and I'm using a 58.10 stop to the upside, right? Because if we get through there, then maybe you're talking about, you know what I mean, like a 5,900-ish or something like that. Does that make some sense, guys?
Makes a lot of sense, especially, again, if we have this little engulfing pattern in the short term. If this selling continues today and we close sort of on the lows, then we're gonna have an interesting conversation.
Yeah.
I just said it. Fuck. Sorry. Apologize. I
guys have
so hard.
They have no idea. They have no idea that Guy screams the F word at least once before Fast Money starts. Matter of fact, right? And he does it like that to kind of scare some of the people on the set.
And it's successful.
I don't mean like scare the bejesus out of him. I mean like this is not. It's
wake them up. There's a lot of lollygagging going on. Sometimes you need to sort of get people on their toes a little bit.
Yeah, but some people, Guy, do not like the F word.
Well,
they do not.
You know what?
I'm just saying.
I mean, in the world we live in today, if that's what they're concerned about, I mean, that's the least of our problems.
You can say that for a whole host of reasons. My mom has never used that. She's 82 years old. She has never spoken the F word. And it used to be, even into my adulthood, she doesn't like hearing it. Now, every once in a while, there's certain things I'm sure
I've dropped a few when your mom's around. She thinks
I know, but Guy Adami is my mom's favorite fast money trader. I just want to be really clear.
That's not true.
And that includes me. All right. This one is the spot. 58.10. That's your stop. I know it's kind of tight, but when you trade futures, you want to keep probing levels. You want to keep probing levels, and you want to take small losses, right? And then you can kind of set up for the move, and then you move your stop lower, right? And so to me, I think this is an interesting level. Oh, geez. Interesting level. I don't know. What else would we say? Riveting doesn't work. I'm not riveted by this level. Okay. This is the level that I want to take a shot on. And then that initial target is really going to like 5,600-ish and then 5,500. That is the line in the sand here, Guy. That's it in the futures.
I agree with that. I do agree with that.
Move on and find
but we have a question. I want to sort of weave in some questions here
Sure.
before we get to Butters. This is from Eric Lancelotti, who is here every day, and I appreciate that. Do you guys think the relative weakness in the Q, and I'm reading, that's why I'm looking down, and the relative weakness in the Qs compared to this SPY is signaling a change in trend? And the short answer is yes, I do, Eric, and I appreciate you pointing that out. We've tried to sort of illustrate that as well, and hopefully people are picking up on it. But there's clearly something going on the tech-heavy trade that we just sort of alluded to with the SMH, the SOX, some of these semi names, and we've talked about Microsoft now seemingly forever in terms of the underperformance we've seen, and that's going on about 8 or 9 months now in terms of Microsoft. So it's not a passing fancy, and I do think there's something to be said here. When you lose the leader, and the leader has been technology, and the technology is sort of shown through the Qs, I think that's somewhat problematic. And look, real quick, you see that moving average. I mean, that is clearly flattened out. That's Microsoft. I mean, if that starts rolling over, that's a bit of a problem.
Yeah, I mean, listen, this is pretty clear. We just went through the SOX. The SOX has been a leader. The SOX has been a leader because Nvidia, its performance last year was 25% of the performance of the S&P 500. I don't even know what it was of the NASDAQ 100. But when you look at these QQQ, that's the, let's call it the cash. Let's go back to the NASDAQ 100 E-mini futures. I mean, this is also, I think, the similar situation when you're looking at a stop, if you're looking to play to the downside. And I also want to be clear, and I hope you guys kind of recognize this, is like Guy and I did not come into this year. We did not leave last year as like the most bearish guys or the most bullish guys. What we try to do is really focus on some sectors and some individual names. Is that fair? And we've also tried to pick what we think are some inflection points, both technically, but also with the news flow, how we are trading the major indices. And so right here, we were totally open last week, a week and a half ago. And you just mentioned Doug Cass. I love the term that he uses when he gets long or short. Usually it's long and intermediate term sort of thing. He always calls them long rentals. I like that. Yeah, that's a good. So he's just renting them. He's not buying them. He didn't put a down payment on. It's not something that he's looking to lock in a rate going forward. And he's going to be in there.
You can walk away from a rental. You're not locked in.
Well, you can cut. First of all, you can cut your losses in a rental. You know what I mean? But if you're going in there and you're looking to do a 30-year fixed on this thing, and you put that down payment, you're kind of in, because the in and out. I'm just saying the transaction costs in and out. That's not too good. I mean, you don't want to do that.
You probably, my sense is you've rented cars. Are you a guy that rents like the fancy like Bugatti or something, or like the
No,
Mustang?
dude,
Or
come on, dude. All right, so let me tell you this.
did you
I
dude
was
me? Wow,
I,
okay,
I
I'd
was
like
in
that.
I was
Tim
I'm gonna
dudes me every
I'm gonna
once in a
send the
while.
picture to Jacob. I was in San Diego over the weekend. I went out there to see my nephew was playing a
San
lacrosse.
Diego, you know what that
Whales
means?
something.
Whale's vagina. I can't even believe I used the word. Bill, do you know this?
This is from Anchorman, people. The guy did not.
No, people know that. If you're watching this show, there's a very good chance you know where
San
that's from.
Diego stands for. I mean, that's a great movie, by the way. And you probably had a thing for what was the blonde in that?
Applegate.
Yeah, Christina.
Christina, right? That's her name, Christina
Yes.
Applegate. By the way, she suffers. I'm not trying to bring this
Oh, I know.
conversation down. I think she has MS, but
Yeah,
she was a rocket in the day, 100%.
yeah. She's great. She was great in that movie. That movie
Great
was
in that movie.
amazing. I cannot believe this is Guy Adami, unplugged,
You brought up
unfiltered.
San Diego. You started talking about rentals. I said, "Have you ever rented a car?" And I said, "I bet you rent the fancy cars like a Bugatti." And you say, "Dude." And then I was just in San Diego. That's how this whole thing started. I remember everything. So continue.
All right, Jacob, you're gonna have to put this up here. So I was in Southern
You
California.
sent him a picture?
Watch this. He's going to put it up. I was in Southern California. I did rent a car for the weekend. Okay. Friday and Saturday night. And I was looking at my different choices. And for $66 a day, I got a convertible Mustang. Okay. And I rented that. And people think it's the
Was the
worst.
license plate
Johnson.
DOUCHBAG?
What does that stand for?
Bill, did you hear that, Bill?
What does that stand for?
Bill, did Bill
did
hear that?
that.
I know
Oh, there
Bill's
he
laughing
is.
right now.
There he is. You know,
Because that's the only license plate that, and if you rent a car like that, you almost have to have that license plate.
really.
But go ahead. Let's see the picture. I can't wait to see this.
No, I mean, like my brother took a
Jacob said he's going to put a picture up.
So I was staying with friends, okay, in Cardiff by the sea. And I also went out there to see them, and their kids were playing lacrosse. So I went with one of their games. So I'm at one of the games with my friends, Jeff and Hayes, and I have my rental because Jeff went with me to that. His wife had taken their dog, and they were there. We were leaving early at some point, and she's like, "Hey, take the dog and go in our car." I was like, "Great, you can use my rental." And I left her the keys. She had no idea what the rental was. Okay. So Hayes and her daughter, who's like 10 or 11 or something like that, they go to the car. They see it's a Mustang. They're absolutely mortified, like embarrassed, because all the other kids are getting in their parents' like little, SUVs or this and that, whatever. And she said Farrah, the daughter, was like crouching in the back. And Hayes
I
was
like this chick already. 10 years old, fifth
what's
grade. And she's
embarrassing
already.
about a Ford Mustang? Like, I just don't understand.
Listen, if you had a 1967 convertible Ford Mustang, that's badass. These new things are.
When I was in college, in CC knows this, in 92 and 93, I lived in the summer in Toronto, and I lived with a family, and I worked at the guy's bond brokerage firm.
Farm?
By the way, bond brokerage firm. This is my first experience.
Or bond brokerage firm.
This was my first experience in markets. This is kind of the thing that got me really interested. I just thought being on that trading desk, I thought was really cool. But I also played, the guy was a part owner of this lacrosse team. That's why I went up there. And he had a 1966 red convertible Mustang. And he let me drive this thing. And after one time, it did not have power steering. It drove like a boat, a beautiful car, drove like a boat. I did not want to drive this car. The only thing I could think about is me like hitting another car and this sort of thing. So that's the Mustang story. That was my first story.
So that's what you rented. I'm still waiting for the picture. I mean, what is Jacob?
What is wrong with that? Guy's speechless. Amanda,
that there's so many levels of troubling there. I don't know where to begin.
$66.
Who'd you have take that picture? Like
my
the person
brother
that rented you the car?
No. My brother walked up.
So what did you say? Like, play this. Amanda's apoplectic right now. Play this out. Like, how did this happen?
Like he walked up to the car because he came in his own.
And you're like, dude, open the door, pretend you're getting out, and I'll take a picture.
I was getting out, and he took a picture because he knows that my kids, every time I rent a Mustang, they hate it, just like little Farrah did. Okay, so it's a family inside joke, guy. It wasn't meant for this, although I did bring it up. All right, can we get back?
That's so good. I hope Bill's laughing right now. Bill, this is great material for you. All
right, so guys,
good.
Let's reset here because people were going to get back on the trail. So we were just talking about Barclays, going
Yeah.
to the low on the street, 5,900. Okay, Guy, if it's Wednesday on market call, it is.
It's time for John Butters, the senior earnings analyst at FactSet. We are privy to his work that drops typically on Thursdays. We get it ahead of time. If you want John Butters' work, this is how you do it. I mean, get it in your inbox. Insight.factset.com/subscribe. Why wouldn't you, Dan?
Well, you can have it in your inbox. Now, we get an early look at this. And, John's work, as we say, is extraordinary. I've been reading his work, I think, for as long as he's been at FactSet. And, this is the exact time of year, Guy, where I find some of the data that he brings up, again, like really informative to, let's say, as we get into quarter end, as we start thinking about what S&P earnings might be, how they've been adjusted. He's been tracking the trajectory of S&P 500 earnings, which is why we made the point where if the Barclays guy is lowering his target, I really, really hope that he's also lowering his earnings estimate for the S&P 500. All right, so let's look at this. This is bottoms up target price versus closing price. The bottoms up target price for the S&P 500 is 69,1607. The target price implies a 20% price increase for the index from Monday's close, which was 57.67. Since February 28th, the S&P 500 closing price has declined by 3.1%, while the target price has declined by only 0.4%. Give it to me, Guy. What's going on?
Okay, so we've done similar before with Elizabeth Young Thomas, and what she has pointed out and what I emphasized was there's always going to be sort of this chasm between the two lines, and the upper line is typically a little more static and you don't have as much noise, and obviously the lower line typically moves a little bit. But what we haven't seen in quite some time is a divergence that recently happened with the sell-off in the broader market. History suggests that you're going to see then this lag effect and then a decline on that upper band number. And I think that's where sort of the rubber hits the road. So keep an eye on this relationship, which is historically intact. You've seen sell-offs before, but you're in the midst of a sell-off now. And I think that upper band at some point acts in kind. And that speaks to what we started this with to a certain extent. Sort of these strategists seemingly now all lowering their price target for the S&P.
Yeah. So, I mean, like, again, we want to keep a track of this really from a sentiment standpoint. I think that's kind of the most important thing. All right, let's go to the second chart, S&P 500 sector level bottom up target price versus closing price. All 11 sectors are projected to see double-digit price increases. 3 sectors are projected to see a price increase of more than 20%. Consumer discretionary, technology, and communication services. 3 sectors are projected to have a price increase of less than 13%. Consumer staples, financials, and energy, Guy.
This is, in my opinion, a bit of wishful thinking here. So I think the market's going to come to the realization. We're almost in April. So you think about it, a quarter of the year is pretty much done. And now there's a hope, I think, for this to come to fruition, that somehow we get it in the back half of the year. But what you're seeing now and what you're hearing from companies and the consumer sentiment numbers that we've talked about a number of times, in my opinion, suggests that there's almost mathematically impossible to see these types of increases. So just sort of buckle up, I think. Now, I could be wrong. I'm wrong a lot. And maybe there is some resurgence in the back half that gets us to these numbers. But right now, and given some of the projections I've seen, and given some of the commentary we've heard from a wide swath of industries, I just don't see it happening.
Yeah. So we got to track this stuff. Just from a sentiment standpoint, it should be a really important input in our opinion. When there was this over exuberance about the market late last year after the election, we saw folks, or at least strategists, tripping over each other to kind of raise their targets. We also have been tracking per Butters' work that we just didn't see earnings estimates last year for the S&P 500 in 2025 coming down. And now we've seen that. And he's been showing us that data over the course of this quarter. So this is just a further evidence from, the fact that they're going the opposite way. Let's see if the earnings estimates come down. I saw Larry McDonald, Guy, old friend of Fast Money. He was out. I think he was quoted in Barron's saying, I think the current consensus for S&P earnings are $270. And he said he could see him, I think, as low as 230. So
yeah.
Think about that.
Well, do the math. I mean, 230, given where we're trading, is probably what, 24 multiple? I just did it sort of the back of my head, but
yeah,
it suggests that the market is expensive. My math might be right. Can we throw a question in here? Because I think this question is going to dovetail to those two graphs we just looked, two charts we just looked at. This from Ari. Hi, Guy. I have a question. If delinquencies have been tracking upward when this is a strong job market, what will it mean when the job market blinks to the downside? Wonderful question. And if you watch Fast Money first of all, we've been talking about this on Fast Money for months now, the delinquency rates going higher. Serious delinquencies, which I think are 90 days plus, are now at about 11.5%, the highest level we've seen since, I believe, the financial crisis. And what I said last night is, I said, look, it's pretty clear we're not in a recession, yet the delinquency rates we're seeing are levels that we last saw during one. So what happens if, in fact, we get into one? What's going to happen? So these delinquency rates suggest something is amiss. And you're right to point out the employment picture. I think the unemployment rate is going to continue to tick higher, and that's going to be a real problem. And obviously people will say, well, the Fed's going to come to the rescue. We'll see. If inflation is still a problem, though, on the other side of it, I don't know what they can rescue. So this is I love this question. And I think more and more people are going to start to look at the numbers under the surface and say, yeah, the consumer's spending, but quite frankly, Dan, they shouldn't be. And they're sort of behind the eight ball in the spending that they have been doing.
Yeah. I mean, the point that you made on a few occasions is that consumers are battling inflation with credit, right?
Mhm.
Like, listen, we get it. It's one thing though, when rates were much lower, right? And so now rates have like reset higher. They don't go down particularly fast, whether it's a credit card or something like that. And then you start seeing, inflation that's sticking around. You start seeing wage pressures. You start seeing worries about, whether it be, jobs and what the employment, picture looks like. And again, this is all serious stuff to us. I mean, we're just messing around on a whole host of things.
This is
No, I know. What
Yeah.
I'm saying is like we spent 5 minutes going off the rails a little bit on stuff that we think is funny or this and that. This is not funny. I mean, this is the sort of stuff like when we're thinking about it through the lens of the markets and we're thinking about the economy, the problem is like late last year, the optimism around what a change of administration, how it's going to fix the price of eggs, how it's going to, fix these geopolitical issues, how the deregulation, like, let's be clear about something. Okay. The new administration comes in and they kill the CFPB. The CFPB was created after the financial crisis when so many consumers were able to do a whole host of things that they should not have been allowed in the financial, landscape of this country. The idea that, oh, take this money, go buy a second home. It's only going to make you rich or, this and that, whatever, or invest with 3 times leverage in the stock market, all this sort of stuff. That's what that agency exists. Whether it was bloated, whether it put unruly sort of regulation on financial services, it existed. The point of it was to exist to protect consumers. Okay.
No, that's fair. And I'll say this, you're right, 100%. But, personal responsibility comes into this as well. And I said, as much as people wanted to sort of vilify Wall Street during those times, I mean, there were people signing on the bottom line for this shit, and they should have really had an understanding of what they were doing. So there's enough responsibility to go around.
Should they have, though? I mean, like, at the end of the day, okay, but the banks all got bailed out. The consumers did not get bailed out.
That's a different conversation. That's an entirely different conversation. You're right about that.
But the moral hazard that was created, and that's why I am totally opposed to bank deregulation right now, because at the end of the day, you do that, and these guys are going to do the same thing they always do. You know what I mean? They're going to do the same thing, and they're going to take the sort of risks that they know will enrich them on a short-term basis. You saw the headline just before that Wall Street bonuses were like the highest they've ever been, this, that, whatever, which is fine. We got tons of friends on Wall Street. Everybody deserves to get paid, but you don't deserve to get paid on short-term risk.
No, I agree with that.
At the expense of consumers that, for the most part, don't know better. Let's use this. Let's throw up the Tesla example. Okay, just put that chart up, the 1-year chart. Okay. The people piling into this stock from November 6th until late December, they don't know what the hell they were doing. Let's be clear. If you were buying, maybe that first day you're buying the stock because you think that Trump's, like the proximity of Musk to Trump is going to be an amazing thing. The regulation is going to be amazing. He's going to get to full self-driving quicker. And that's going to be the thing that makes this company, increase their margins. And then they're going to get to robo-taxis and they're going to take over the world with robo-taxi. And you know what I mean? That promise was built into that stock for totally bullshit reasons. Like, he's a cult leader and the people follow him. And, like, listen, when you're mesmerized by somebody and you're mesmerized by the promise of just bullshit, because it's all lies. This is a car company right now that was trading off the promise of robots and robo-taxis. You know what I mean? And look at how quickly that came undone. Like, yes, there should be some personal responsibility, but every single person who has bought that stock, you know what I mean, whether it was on the way up or the way down, other than like last week, have lost money in it. You know what I mean? And so you and I have been trying to talk about it. You and I have been talking about when you buy into a bubble, it doesn't end well unless you have the smarts to sell. And I don't mean the smarts. I don't mean the people who like didn't do that are dumb. Okay. But like, this is history repeating itself. It's not even rhyming. It's repeating itself, guy.
No, listen, I hear again, I hear everything you're saying, but people went in. If you go back and look, I mean, a lot of people should have said themselves, you know what, this doesn't make a lot of sense to me given our position. Maybe we shouldn't be doing this. A lot of people didn't. A lot of people thought, it's that whole saying, if it's too good to be true, chances are it is. Now, I'm with you in terms of these agencies that are in place to protect people. A lot of times people need to be protected from themselves, but they don't want to be for whatever reason. Anyway, we're off the rails. Let's continue on our journey here. This is an interesting chart of the day because, I mean, this speaks to something we were talking about earlier, how quickly sentiment can change.
Yeah. I mean, we spent some time talking about this on Fast Money last night. So this is from the Daily Shot. This is a great read, by the way. It comes in your inbox, and I don't know this guy. We have no.
I don't know this Merle. I don't know what he does.
Yeah,
I don't know how he makes a living.
Michael Corleone. If Guy could be any person in
I am Michael Corleone.
Real life, in real life or doesn't exist, obviously.
Yeah. No, see how cold he was? Like that, just like he never changed expression. No. The entire first movie and he literally never changed expression. I love that.
Yeah,
he's amazing. Sort of like Jalen Hurts is sort of the Michael Corleone of the NFL. I'd never. It's amazing to me.
You love Jalen Hurts.
I love everything about him.
Yeah, I can't wait to see Russell Wilson versus Jalen Hurts in the NFC East rivalry next.
He's probably got some gas left in the tank.
Yeah, so
guys, you want a guy, Dan? I'm sorry, Amanda, and everybody else that's listening. You want somebody behind center that can get you in and out of the huddle, that can sort of run an offense, that understands things. It's not helter-skelter. Russell Wilson is that guy. And you surround him with some weapons, and the Yankees. The Giants have him in the form of Malik Neighbors and some of the other guys on the team. I think the running back proved that he can play the game. You get Andrew Thomas back, and all of a sudden, maybe you're not as shitty as you think. The difference between 3 and 14 in the NFL and 14 is 3 is not as wide as you think. Back to you.
Yeah, I'm with you, dog. I don't think this is going to be an Aaron Rodgers situation in New York. I'm just going to say that, okay? Like I'm with you. I heard you say on the set of Fast Money, not live on the show, you think this is an 8-win team this year, and I hope that's the case. And I hope it's a rebuilding year for you, Bill, and all my other friends who are Giants fans. Back to the rundown. We talked a couple weeks ago about consumer confidence. University of Michigan, we had a bunch of strategists on the Rich Reversal podcast that were talking about how it was right down party lines, right? If you're a Dem, you are very pessimistic about the economy. If you are an R, then you're very optimistic about the economy. I think a lot of that optimism is waning in this data, okay? So let's just be clear about that. But let's now go to yields. And I actually have an update, Guy, on the TLT trade that we put on, I want to say a week ago Tuesday, but let's look at yields for a second here. And, I don't know if you care as much about the technicals as the reason why the 10-year yield has firmed up. Give us your 411, because when we did that trade idea last week, I was bearish on yields. You were bullish on yields. So I was buying a call in the TLT. You were buying a put. Yours is right. Mine's wrong. We're going to talk about how.
I mean, that trade within a day worked in your favor. And I think, what we talked about that day was there was a flight. Remember, the market had been selling off. The broader market had been selling off into that. So I think in terms of the bond market, there was this flight to, I use the word all the time, perceived quality in the form of bonds, which made TLT go higher, which sort of made sense. And also you saw some deterioration in some of this economic data. Now, the flip side of the coin is, and we're going to talk about copper in a second, but some of the inputs that we talk about all the time, suggest inflation really is not under control. Now that you've seen the market get back on somewhat stable footing, the last hour and a half notwithstanding, I think you've seen money coming out of the bond market and in the equity market. So the question is, when does everything start to care? When does it start to matter? And I think Carter will point out, you've pointed out that, maybe rates are not as important as I make them out to be. And there's probably some truth to that. But I do think there's a level where it does become important. And I'm going to continue to say, I think yields are going to go higher for the reasons that the market is not prepared for. And we'll see how it plays out.
Yeah. And so what's, to me, what stands out on this chart is that, you found some support at that flattening 200-day moving average. But since we've been talking about this over the last week, it's really been a 10 basis point range, right? Like in the 10-year yield. So it's kind of stuck here. Let's see if it can break out. You see where that kind of, I want to say 445 level was the low end of that range, guy, before they broke down. I want to say about a month ago or so. So a lot like an instrument like this does trade a bit on technicals. You almost see that match double bottom that we had just a few weeks ago, right? So let's go now to the TLT because, when I look at this, all right, so Amanda's got this kind of where we were looking at this trade. So the TLT was at 90.35 when I was buying the April 91 call. I paid 122 for that. All right. And we use a 50% premium stop. In this case, when 122 gets cut in half, you can do the math on that, right? And so 61 cents was kind of that stop. So let's go to a 2-day chart right here. You have the TLT at 89.19. It's down $1.10. And the premium now has been cut in half. This is in April. We have like 3 weeks to this. And this is one of the reasons why, if you get the direction wrong, even in a low vol instrument like this, look at how much premium has gone out of this option. Now, if I were to have bought the ETF, I'd be down $1.10, $1.15 or something like that. I could wait it out. You know what I mean? I don't have like time expiring me, but the call has lost more than 50% of its value. So you better cut your losses. That's what I did today. The stop got triggered, but look at the breakdown. You had a gap lower here, and my 62-cent stop or whatever it was, I sold it at 58 cents. So you're not always going to get your price, especially when you have a sort of gap move over, overnight or something like that. So I just wanted to be really clear about that. Do I like taking losing trades? No. But do I like trying to stick around and like kind of hope that it comes back? You know what I mean? No. So like I have to take some small losses here and there, especially when I'm trading options. That's how I'm thinking about it, guy.
We have a question about ARM Holdings from Clark Kemp, who's been with us as well. And he asked, what are your thoughts below $100? Is that a good entry points? Lastly, what are your thoughts on selling a naked put at 90 if I'm good owning at that price? Well, I will tell you flat out, I'm never a huge fan of selling naked puts unless you're getting paid a ridiculous premium to do so. My sense is you're not here in terms of the risk reward. Bad things can happen. And this is a strategy that probably works statistically 75% of the time. The problem is 25% of the time it doesn't work. You blow yourself up. In terms of ARM, I think at one point, Dan, and you probably have it in front of you, this was over a $200 billion market cap company that sold off pretty significantly. And you also have in front of you what their revenues are going to be. I mean, their revenues have probably been between $3.5 and $5 billion for the last 10 years or so. It's a pretty mature company. So you can do the math at $125 billion. I mean, price to sales, in my opinion, makes 0 sense for a company that you're not really seeing robust revenue growth. So I think there's downside here in ARM.
Yeah. And the way I think about this, you didn't give us an expiry about selling that downside put. And, when you think about like, you see those intraday lows that we had, this goes back to April of last year. And then again, August of, last year too, when we had that kind of crescendo lower, it's kind of holding in here, but like, you have this stock at 118.5 or so. And I see what you see as far as 90. That might've been that might've been close to the low back in April a year ago. But if I look at, let's just say I look at the May 90 put, okay, with a stock at 118. The May 90 put is probably like $1.65. That's less than 2%. Okay, but that's a ways down there. So let's just say you sold that at 90. You're taking in $1.65. You're really 88.35 is where you buy the stock. Now, that's fine. And I think the probabilities you laid out, Guy, and we're gonna start having CC pop in with us. CC going back to the late 90s, he was a market maker in options. Like, think about that during the bubble period. I think he was trading all the internet names too, and some of the telco names, and the spreads were wide. These companies looked very different, and the like. And the way options traded back then were very different too. But you just said it, you know, 3/4 of the time you sell a downside put that far out of the money, you're going to make some money. Okay. For the most part, right? Through decay, like the likelihood other than an event, whether it be, you know, a single, you know, like you know, earnings or something like that they blow, you know, you're going to make money on it. Are you like, what is that expression? You're kind of picking up nickels off of the train tracks or something like that. So generally not a great do. I will also say there's a 10 delta on that option. So the options market is saying there's only a 10% probability that option is in the money. But as a rule, you don't sell single digit delta options for the most part, right? So again, it's not a great risk reward, but we just showed you the situation with TLT buying a long call. You know, we lost half the premium in a little more than a week with not that significant of a move, like a 1.5% move lower in the underlying.
Let's take a real quick look at copper because we teased it earlier. And, you know, again, there are reasons why copper is trading the way it is. And I've said it on Fast Money. I'll say it here. I think part of it is the market trying to get ahead of tariffs. I think that's a big part of it. But there's clearly something else going on here. And as important as crude oil is to the global economy, copper is pretty important as well. And in terms of inputs and inflationary things, you can put copper at sort of the top of the list. So if the Fed thinks they're winning, or if market participants think somehow the Fed is winning, well, it's not winning through the lens of copper. And then we just want to sort of point it out. I mean, if you go longer term, you'll see where we are now and where we've been. I mean, this is at levels we haven't seen maybe ever in terms of the copper market.
But guy, doesn't it, the price is the price, the input cost is the input cost, but doesn't this have a lot more to do with tariffs than it does demand, right? And
Probably.
yeah. So like, I think there's different ways that you can, you know, get to, you know, the price making new all-time highs and breaking out of a long sort of base. And I just wonder, you know, we get to a point next week, April 2nd, they basically say, all right, we're going to, you know, not put those tariffs on and we're going to relook at it in a month or so. I just think all this stuff is going to lose some teeth unless they go the opposite way, unless they really dig in. Well, then that's the scenario where you're going to start seeing inflation expectations going higher. You're going to start seeing consumer and enterprise spending, you know, drop off worse than what they already have. And that's just going to be a bad situation for the economy. And I do not believe that they want to tank the economy. I think they're signaling it. But, you know, I can't remember who we had on the Risk Reversal pod last week, maybe, who said that, you know, like this is a different stance. When you're, oh, I think it was Vinny Daniels. Wasn't it Vinny who said you got to take them at face value? If they're not worried about the stock market, it makes no sense to kind of take the other side of that trade, because you might be right, but the likelihood is if they really hold their ground, then the stock market's going much lower.
Which is why you have to turn your attention to what's going on in the bond market. And, you know, right now they'll say their focus is yields going lower, but if yields start going higher and they say to themselves, you know what, maybe we don't have the control that we think, then their focus will turn to the stock market and they'll start doing what they can to jawbone that higher. So this is a tightrope with no net. And, you know, the market's trying to sort of, I think, come to grips with it right now, which is why you're seeing the moves that we're seeing. And by the way, one of the reasons why I continue to think that although volatility has come off, I think there's going to be this resurgence of vol over the next couple of weeks. But that's it for today, Dan. We covered a lot. Amanda's mad at me, I know, because I brought up Mustang.
I mean, you know who's not mad at you, CC. He likes the banter. Amanda does too. She's just a busy.
Hockman was last. I guarantee Hockman was last.
So let's close it out like this. If you want John Butters, you want the insight report, the earnings insight report that drops, I think, every Friday morning, by the way, guy. You and I get it in our in-mail box. They actually have a lot of great stuff that comes out all week long on the sector front and the like, but John's report drops on Friday morning. Go to insight.factset.com/subscribe. Have it in your email box, but obviously always tune in here on Wednesday because we're going to preview it, guy.
I enjoyed today. I learned a lot. I only said interesting once, and I let out an expletive that I'm sure irritated
people.
Well,
there was two. Well, I mean, the second one is not an expletive, but it's one of those ones that some folks think is kind of unsavory. You know what I mean? To kind of use that word. No. I'm not even going to bring it up.
I said expletive, the F word.
No, that's an expletive, but you also went off the rails with another word that some people just don't like to hear out loud. You know what I'm saying? No, I'll tell you in the break. And maybe
in the break.
Yeah. All right. Lots of fun. We'll see you here tomorrow morning. The Risk Reversal podcast drops, and then we have the market call, 11 a.m. Eastern. My favorite time zone. Guy seems to be partial to it too. We'll see y'all tomorrow. Thanks.